Thank you, Kerala Startup Mission. It feels special to be in Trivandrum. So, no startup conference these days is complete without a discussion on funding winter, and we are doing the honors. So, in the first quarter of 2022, when the signs of an investment slowdown became visible, Dara Khosrowshahi, Uber chief, he wrote a letter to employees saying that we are entering into a long bearish cycle, which probably the longest in the modern history. Whether that forecast turns out to be true or not, we are right now in the 8th quarter of a funding winter. This year, I think the VC investment is trending about 70% lower than the last year, which in itself was 38% lower than the previous year. So, and last quarter, the third quarter of 2023, at 1.5 billion, the VC investment was 5 years low. So that's the context that we are, we are having this discussion. Renjit, you have been investing for the past 16 years. So how would you describe this phase, and how did you adapt to this new environment?
All of them have raised funds, and you look at the large global funds, they have raised tons of capital sitting on it, right? But it's just the fact that, some of the valuations at which companies have been done at has been come into question. Now, if you look at this whole startup funding, whether at seeds, early stage, which is A and B, and then upwards, there is still activity happening at seed and Series A level. Series B upwards, there is really no activity, right? For us, at least in our portfolio, the focus has really been on profitability. How do we work with these companies, cutting down flab and trying to see, can you get these companies to become profitable? The other piece is also the founders. What is interesting, we've been investing in India for the last 13 years. The crop of founders that have come up in the last 4 years have really not seen down cycles. This is the first time they're experiencing this, right? So if you look at the companies that we did in Fund 1, Fund 2, think about a Lenskart, think about a FirstCry, those founders were, fairly, constrained with their capital, even from the very beginning, which was not the case in the last 3-4 years. The funding was really easy to raise. Companies raised, a seed money at, say, $5-6 million. Series A becomes, $20-25 million, and so on and so forth, right? So in terms of valuation, so the amount of capital available for them to play with was significantly high. So the quality in which they've built companies was completely off track. And now I think in one way it is good that there is a focus back on profitability, looking at unit economics of the business and building it in the right way. And that's the focus that's been there for us.
All right. So best companies are built in constrained times. Yeah. Anil, so you have been investing, again, a decade plus 13 years, and you mostly focus on the seed pre-series stage. So when the funding slowdown happened, it first hit obviously the late stage, growth stage, investments. 100 million rounds were few and far between, and it still continues to be so. But I think this funding slowdown percolated down to this seed stage maybe slightly later. There was a lag effect. But how did that play out, and how is it right now?
So, I don't know if there is really something called winter, though I am wearing a jacket. I thought it will be cold here. No. So I define this in two buckets. Renjit has already done it. One is the bottom, right, where you have seed money and pre-Series A type, and then you have Series A and upward. I think the bottom of the pyramid, I haven't seen any change. In fact, a lot of money is available, unlike in past when people were actually not investing, right? There was a issue of liquidity, there was issue of money with people. Today money is there. The only thing, the people are not able to invest at the number what people want to raise in, and that's the reason we are not seeing much investment happening in Series A, especially Series B and D. And whoever have raised money have sufficient capital so that they are not willing to compromise on their numbers, right? I have read a lot of news about companies in growth stage able to increase their runway for number of months. Like one of our portfolio company had a runway for 21 month, 12 month, now they have runway for 36 months. So they don't need money. When they don't need money, they are not going to compromise on numbers. So that's the reason investments is not happening only in places where they are profitable or they're doing really good. But coming to bottom of pyramid, I think more and more money is coming in. Not only from angels. In fact, I still remember, and Renjit can vouch for it, when I started my fund 8 years back, we were 5th in India. Now after 8 years, we have more than 300 funds. And recently I met at least a dozen of people who are waiting for their approval from SEBI. So a lot of money is there. So there is nothing called winter. It's only that, the top of the pyramid, there is not much action happening because of expected valuation. But the bottom of pyramid, in fact, we have made more than 8 investments, right? We are still writing check. And I was talking to Renjit this afternoon that we are looking to invest at least in 4 companies in next, 1.5 months. So there is nothing called winter. Yes, there's corrections are there.
So you mentioned about proliferation of funds. More funds are coming up. So maybe I think that's that's an ideal thing to connect with Shoeb, because your fund, you're a specialized fund, focusing on clean tech and decarbonizing supply chain, mobility, etc. So in clean tech, and you are a fund which is born during the so-called funding winter, 2022, right? So in yours, in clean tech, in fact, so we see it's a sunrise sector where investments are, there is a lot of interest at least. So what do you actually feel, is there a slowdown effect there?
Yep. My name is Shoeb. I run a venture capital fund called Transition VC. Just to give you a brief about our fund, we are a new fund focused on energy transition as a sector, investing in technologies or engineering startups who are trying to build, deep tech technologies, reducing directly or indirectly carbon emissions. That has been our broad focus areas. Coming back to the question, so if you look at the numbers, right, over the past 3-4 years, I'm taking the average numbers, the amount of money that is flowing into venture capital investments, especially, the average number has been like somewhere around 12 to 14 $14 billion of money has been invested in startups. That's an average number if you look at from 19, 20, 21, 22. And roughly 1,200 to 1,400 startups get funded every year. Again, that's an average number, slightly more or less. But 2022 was an exceptional year where all the numbers have been on the higher end, especially when it comes to the amount that is invested in startups, and at the same time, number of startups that have got funded. 2023, if you look at the number, surprisingly, so far, just $5.5 billion worth of investments are done by VCs, and roughly only 700 startups have been funded, vis-a-vis when respect to 1,400, 1,500 startups were funded in the previous year. So there's a drastic 50% reduction of startups funding. Even the valuations were stretched in 2021, 2022. Now even valuations have been rationalized. We are seeing both in terms of number of deals, valuations, a stretch. I don't know whether we call it a winter or not. Any economy, whether it's a global Indian economy, goes through in cycles. So it's natural to have cycles. I mean, there's are ups and downs. You can't time them, but at least every 8 to 10 years you see few years where you get superb funding, and then few years you have downward funding. So primary reason being like you had a lot of liquidity, lot of government stimulus, a lot of institutions they didn't had any opportunity to invest in money because they were literally zero interest rate in US and very European nations. So a lot of institutions, large institutions put money in VCs. So VCs had a lot of capital to deploy. So that's the reason we have invested a lot in startups. Valuations got stretched. Even sometimes fundamentally not great ideas got funded. So this year it was natural to see a downturn. Coming back to the question of whether climate tech has seen very similar trend or not. If you look at the numbers, right, again in climate tech, if you talk about India, 2021, roughly $700 to $800 million were invested in climate tech. This year, we are seeing, last year, 2022, approximately $1.3 billion. Again, we are seeing the same numbers this year. Fortunately, climate tech was one of the sectors where the impact of slowdown was not felt. Obviously, because of the reasons, any sector, I mean, this is one of the brightest sectors what we believe has the potential to bring out a lot of unicorns. There's a huge market there, especially because any sector which when you call a sunrise sector, what is a sunrise sector? Any sector which has 3-4 elements going in tandem. Here, one, policy, and second, markets were favorable. A lot of institutions have pledged capital for climate, and a lot of entrepreneurs were passionate to build some startups because they felt climate is a huge challenge and they want to focus on building technologies there. So all these things came together, and this led to a sunrise sector, whatever you want to call.
Okay.
But these tailwinds helped in building this sector, and that's what we are seeing.
Okay. So clean tech or climate tech is a green patch in true sense. Okay. So Vineet, I read this fascinating note by my friend Roshan on Konglo Ventures. How you started this informal network of angel investors in Kerala and channeled 50 crore into dozens of startups here. So this network of angel investors, are they also hesitant to loosen the purse strings like that we see elsewhere? I mean, or are they immune to this global trend that we are currently seeing? So,
thanks, Manu, and I know you briefly introduced me there. I think just for the benefit of everyone in the audience, I'm Vineet Mohan. I co-founded Konglo Ventures, which is an angel network based in Kerala. We started 10 years back, and we celebrated our 10-year anniversary. This is what you were referring to earlier. Over the last 10 years, we've made kind of investments organically. Our network has grown. And, the scene is very different today from what it was, say, in 2013. Like when we started investing, it was very few people. In fact, when my co-founder and we started Konglo, the idea was for us to invest in companies. And then we realized there are other like-minded folks who are also looking to do the same thing. So we thought, okay, it makes sense to bring people together, right? And spot opportunities together and so on and so forth. And over time, that has grown. And today, alongside Konglo, and there are several other prominent networks and funds as well, right? There's Malabar Angels, there's CAN. And I think, Manu, you made a joke which probably only some of us heard. There is no winter in Kerala, that's just the natural state of things, right? So, and I just moved back from Scotland a few months back, so I know very much that is the case. But the fact of the matter is, when I speak to my colleagues and friends in some of these other angel networks, we've all been investing. So Konglo itself, one example I can give is, so we are a 80 to 100 member network today, and we started a fund earlier this year, because that was always part of something we wanted to do. And most of the members of our network have joined as LPs in this environment. So we started Q4 21, capital call was Q1 22. So people are willing to invest still. We've made 5-6 investments. When I talk to friends, colleagues in, say, Malabar or CAN, they've all made 3-4 investments in recent months. So again, I think it goes back to the point that Anil and everyone else is making. Investors are investing. I think unlike 21, 22, there is more time for us to make the right bets, take our time in terms of diligence, vetting, and so on and so forth, which I think is a good thing, which is how it probably should be. On the other side, however, when I do talk to companies within our portfolio or in general, I think investment decision-making is longer. So some companies who are caught up in the tail end of the cycle, where they're running out of funds potentially, trying to get break even, there is some cases where even good companies might get caught up, and that's never a good thing. But I think that hopefully will also change.
As the first round of our conversation comes to an end, I think we should declare there is no funding window. So, okay. So, the second theme of our conversation is value-based startups. So, I think it refers to building long-term value, the startups which are fundamentally strong. Renjit, you are an early investor, the first institutional investor in Uni4, so which went on to become 2.5 billion valued company. And maybe its valuation has gone further up, but I think they have not raised money from there. So, but they, of course, recently they reported record profits. Their revenue is also on an upward trajectory. Also, they were on the Deloitte Fast 500 list in the US. So maybe they are an example of how fundamentally strong, financially solid companies are built. So can you elaborate on that experience?
Sure. So I think we invested in Uni4 in 2014. I met Umesh Sachdev, who is the founder of Uni4 at IIT Chennai. They have an RTBI incubator there, and he was trying to build something which will democratize communications between, machines. Think about it like that. And he was using speech, because speech is a very natural way of communication. And the thought process was that, across languages, you should be able to talk to machines, which we thought was a very interesting idea in 2014. Now, what is, a lot is written about the company and so on and so forth, but, that company is 17 years old. Okay? It's not a new age startup in that sense, right? Because the fact is, what we're trying to build is something very core and very technologically, technology is very core to it, right? It is not the application level software that you build, right? Speech engines and across multiple languages and so on and so forth. Now what was interesting is that, when we invested, they were a license-based software company doing about 15 crores the year we invested. They were doing 15 crores in revenue. And we were, at that time, 2014, we were clearly seeing this shift happening towards SaaS. And I remember sitting with Umesh and saying that let's stop this business, let's re-architect the product to SaaS. So from 15 crores of revenue, it came down to zero. Right? They had to re-architect the product, start the selling process again. Right? So I think the previous panel, they spoke about pivots and so on and so forth. It was a critical pivot for them. And the world has significantly changed since then, and the focus so much more on artificial intelligence, and it plays very well to what they've been building over the last 17 years. Now, having said all of this is not, again, I mean, the spaces that you choose are important, because the space that Unifor has chosen, it is not a space where small amount of capital is enough. You have very large players who have significant amount of money investing into building AI. And so they will continue to invest. The company's raised close to $600 million investing in building the platform and so on and so forth, right? But my point, when we build the company, it's taken them 15 years. So they survived 15 years to reach here. And that's the point. I mean, they've been around. You see very few companies today who last that long for success to happen. People are looking for faster successes, and that doesn't happen usually. I'll give you another story, FirstCry. We invested FirstCry from Fund 1. When we invested in FirstCry, they had negative gross margin. It was a negative gross margin business. Hopefully that company will go public in the near future. It's profitable today, right? Now imagine a company that is like minus 8% gross margin to becoming EBITDA profitable at a scale. So it takes time to build companies. So what's important to keep in mind is that you start small, you make sure that you have the product that is right, the market fit that is there, and all of that doesn't take too much of money, by the way, right? So if you build it in the right way from the very start, it is possible for you to last 15, 16 years and then build it out. And that's the way really I would think about, there are very few companies that have gone on to $1 billion in 5 years and have been sustainable at that level, right? All these companies that you're talking about, whether it's the Freshworks of the world, or even Flipkart for that matter. I mean, it's one thing that they got sold, but it's taken them so long to build this platform out. So it takes time to build companies, and you have to pace yourself, whether it is in terms of your cost structures, your funding cycles, and so on and so forth.
So it takes time. It takes time to build, so horses for the long race, so basically. Anil, coming to you, something fascinating about your fund is that majority of your investments are outside the top cities in places like Kerala. So, and that, I think, that worked very well for the fund as well, So you have a couple of wonderful companies from Kerala on your portfolio. So like Open and Gen Robotics. So can you tell about the discovery of such interesting companies outside the cityscape?
So I think we had been lucky to find some real good jewel outside Bangalore or Mumbai or NCR. In fact, I think 65% of our portfolio come from outside these three cities. In fact, I think almost 40% of my portfolio come from Kerala. And we have investments in places like Bhubaneswar, Ahmedabad, Pune, Jaipur. So normally VCs, don't want to invest in places where travel is an issue, because it takes a lot of energy, to monitor, manage those investments. But luckily, what happened, we had some unfair advantage because of background early mover. While the VC industry was getting built, I had an opportunity to run India's, largest angel group, and that helped, building some relationship within the ecosystem, right? The biggest issue for VC is to find investable opportunity they would like to spend more time where they can actually, evaluate more company. But unlike most of my peers, we were lucky to keep getting good, reference from tier 2, tier 3 cities. And we found that like here, especially in tier 2, tier 3 cities, the entrepreneur is focused more on solving a problem. And if you're solving a problem, like just in previous panel, we had Gen Robotic, right? Now, normally not a single VC will look at a company which is one, doing something with manhole. Secondly, it is all, government business, right? But they have not only, broken the zinc of building a high-end product, which is, enabling rehabilitation of, workers who are cleaning manhole. At the same time, they have beautifully built a business relationship with this ecosystem, right? So we have found people are solving real problem, and if you're solving a problem, there are takers. And that's the reason most of our portfolio companies coming from these cities are not only growing but are profitable. In fact, I'm proud to say that, all this portfolio had helped us return, handsome return to our investors. And as long as investors are making money, I don't think we will stop investing in these cities, right? So another good thing was happened, like now everybody would agree that it doesn't matter from where company is coming, because I have a company, in spite now world is normal, 100% of people work from home, right? So no matter, where company is from, today working is not an issue. Earlier, we wanted people to be in office, people to be in, accessible place. That's not the case anymore. The infrastructure has improved. Availability of talent in smaller cities is not an issue, right? So that is what has encouraged us. And after seeing success, I think I have many of my peers who have now started investing, right? So I see one day I am encouraging Renjit to also start looking at, outside Bangalore. I'm not saying look at Cochin or Trivandrum, but look outside Bangalore, right? So there are opportunities. India is evolving, and I'll not be surprised that in year 2026 or maybe 2025, we will be having some totally different conversation that people will have 50% of portfolio outside metro, right? So India is changing. It's good for ecosystem.
No, Manu, I mean, if I can add to that, right? I mean, see, this is something that COVID has kind of really pushed forward, right? But people went home to their hometowns, and then they figured out they can start from there and do the needful. So I think it's a very clear trend that we're seeing in our deal flow also, that outside of your traditional Bangalore, Delhi, Bombay, and Chennai, we're seeing companies from Indore, and we've invested in Indore. We've invested in a company from Calcutta. Anil, we just made our first investment in Kerala about some time back.
Fabulous.
So it is definitely changing, and I don't see any reason why VCs will be all over, not just being in Bangalore and Bombay.
Great.
In fact, just referring to previous panel where one of the panelists referred that we don't have good, VC ecosystem in Kerala. I don't think you need good VC ecosystem in Kerala. You need good entrepreneurial ecosystem. If that's there, trust me, you will have all VC coming in. If you make 100 VC sit here, and if there are no startups to invest in, what you do?
Sure.
Right? A friend of mine now have come from Scotland, right? Beautiful country. Now sitting the place where there is no winter. He's looking to make investments here, right?
Yeah. So Anil, you said, you have 40 companies from Kerala, something like that?
I have a portfolio of 35 companies.
Yeah.
I think around 40% of my portfolio is from Kerala.
Oh my God. Okay. So if I ever do a story on Kerala startup ecosystem, I think I should come to you. Okay. So you are the authority. Yeah.
Sure.
Yeah. So, okay. Shoeb, when it comes to climate tech, I think sustainability at the core of climate tech investment in any case. And they're fighting real problems. Also, so from a financial sustainability point of view also. So we might probably, of course, it's very early stage, very fledgling stage. And you are on the cap table of companies like Exponent Energy, which is coming up in a very encouraging way. So what do you see, how is the company building activity in climate tech? From a sustainability, financial sustainability point of view.
So if you look at especially sectors like, for example, mobility, stationary storage, such kind of sectors which are part of climate tech. So they're surprisingly a lot of these startups, right, who are building technologies, trying to solve real problems at the same time. Now, a lot of these ideas are unit economic positives. So, especially on the mobility side, 3-4 years back. So, when we were looking at a startup, we used to look at whether it is over the period of time, is it a total cost of ownership is positive or negative. Now, there is technologies, especially in few subsectors, have come to a stage now where they're competing with the traditional technologies, especially on the mobility side and few on the storage side. So now we are come to a point now these technologies can compete with these traditional technologies. So we keep, it's just not building technologies in these sectors. I mean, definitely if you look at the missing piece, you have capital, you have policy, you have markets, you have customers who want to adopt green solutions. But the only missing piece has been the technologies, especially. So there's been survey from IEA trying to see on a benchmark of 0 to 100, on a scale of 0 to 100, they find out what are the technologies available globally to be a net zero as a planet. And they found out of those 100 technologies, if there are 100 technologies needed to be a net zero as a planet, there are only 20 to 25% technologies which are readily available and commercially available. And remaining 30% were very early stage, and the remaining 40 to 45% of these technologies are not being even developed. It means they are not even at a idea stage or a prototype stage. So the only missing piece is technology. That's why it's very exciting for venture capitalists who are investing in these sectors, and also that's the reason I would say a lot of entrepreneurs, if they are thinking about startups, think about this sector. This sector will throw a lot of opportunities. It's just not a fad, because this time all of these market forces have come together, and you can build really good startups. And our estimate is by 2030 you will have at least 10 to 12 startups within climate tech space coming from India and becoming unicorn.
Great. Okay. So
the other thing is also interesting. It is not just from the demand side, but supply side. Our investors, the LPs, they also have started asking in terms of ESG component being important and sustainability and all of that. So there is, we have investors too. Yeah. So there is a push from the top to look at technologies that are more sustainable, more better for the future, and so on and so forth. So I think it's a win-win for all.
So your ESG portfolio also growing.
Sorry?
Your ESG portfolio is also growing.
Yeah. So I mean, we are not. I mean, we are an ESG fund in the sense that
of course you're not. But I'm saying that among your investments, the percentage of say climate-focused companies or
So what we've started doing is we've started measuring impact.
Okay.
Okay, because that is becoming important for our investors. Because, like he said, sustainability, future, and everything is far more critical, especially if you're raising money from international markets like Europe and the US.
Sure. Okay. So, Vineet, you invested maybe, I think, 6-7 years into your career, right? When you started, maybe in your 20s you made your investment, right? Your first investment, 5 lakh check in cash stack. So maybe your friends at that time, maybe they must have been thinking about buying a fancy bike with that kind of a money, and you invested in a startup. So, but I think the journey has been great. Stack went on to raise some $80 million dollars and move to US. So, can you tell about that journey?
Sure, no, thanks, Manu. I did a quick mental math on my age there, but no, I think it's very fond memories. So I think just looking at the value creation, I think theme that you were kind of looking at, right? So I think as an early stage investor, I mean, fundamental questions that you look at to assess a business, I'm sure everyone here does this, is the problem statement genuine? Is it like a real pain point or not? If it's a genuine problem statement, how big is the opportunity, right? Is it worth going after economically? And third, can this team sitting in front of you execute on that opportunity? Why do we ask those questions? It's because you want to invest in a company that can create tremendous value, right? So that is the whole idea, because only then can you actually look at from an investment standpoint. So CareStack is very interesting because it ticked a lot of those boxes. I will admit it was our first investment, so there was a fair element of beginner's luck as well. But I think the founding team, I mean, I'm sure many of you here are aware of what CareStack does, but they build practice management software focused on the dental industry, starting with the US. So that's a massive, massive industry, billion-dollar industry, and the legacy systems are quite broken, not fit for purpose today. So they found an entry point there in terms of building something for that. And I think Abhilash Krishna, or Abhi as we call him, he knew that industry from his kind of prior work in the US, and he had identified some of these issues. So from our standpoint, it kind of made a lot of sense. He showed the right attribute in terms of how he was going to build it, what his kind of vision for it was. I mean, as with most companies, I think you were talking about First Cry, the pitch deck then and the pitch deck now has changed tremendously. But the focus for him from day one was, let me build something that is product first. So if I get the product right, then eventually people will come and pay for it. And that product has seen good iterations over time. I mean, and it's seen as ups and downs. As investors, we've also seen that, right? I mean, I won't call it near-death experiences or anything like that, but the CareStack has also had its challenges as it's kind of gone through that journey. But they were very product-focused. I think they leveraged the arbitrage in some ways. Their entire dev team sits in Trivandrum today. But their frontline team, the sales team, is based in the US because that's where their market is. In terms of investors, they got top-notch VCs and he was able to get them in. But also strategically got some strategic investors like large dental groups in the US. And that was a tremendous partnership, right? Because it's not just the money that you raise. Suddenly you have someone who can help you distribute, who can help you iterate your product. So I think it was all tactically and strategically done very astutely. So it was interesting as an investor to kind of look at someone who is not trying to just make a quick buck, get to $1 million ARR or anything like that. Very much focused on the US market, try and get your product right. And once your product is stable, it'll scale. That's kind of what the playbook there was. And today, I think for us, I think it was, initially, like I said, it was our first investment, so we were also getting into something new. We were always keen to the fancy bike wasn't as attractive for us back then, thankfully. I think startups as an investment class was very, very interesting. And I think where we've invested something in CareStack, which has done very well, we've also made our mistakes. But with CareStack, I think the good thing has been that we've found a founding team and an operating team that is very much aligned in terms of what they're trying to build. So I think as an investor, it's very exciting, right, to see that journey. You're seeing a company that's kind of taking its baby steps and then growing and then really capturing a market which seems very alien for many of us sitting here. Because you're talking about the dental industry in the US, which most of us don't really know about. So from that standpoint, it's been a great learning journey for us as well.
So last question to, it's an open question to all panelists. See, if we look at public markets as an early indicator of a recovery, the startups which got listed, of course, they all had their sort of, that so-called tech meltdown. And then in the last, their stock price has, all of their stock prices have doubled in the past 6 months to 1 year. So, and also the leading unicorn, many of the unicorn startups in the private capital world. So they all have seen markup, while they have seen markdowns earlier. Now I think they start seeing markups as well. So is it a sign of, an upward trend that's slowly picking up? So Renjit, we'll start with you.
So there's a correlation. Typically, what happens in public markets will definitely have an impact on the private markets, because if you look at, if the valuations or the prices of the public market
Shoeb, just one thing. So all panelists will have 1 minute each. Okay.
Okay.
We'll finish it.
Yeah. So if there's a correlation, as I said, if the public market valuations are stretched or they are overpriced, typically that allows late stage VCs or private equity players to place their valuations again with a little bit of liberty. They can stretch. So and when you have your late stage valuation stretched, typically that flows to mid stage and early stage. Typically early stage VCs or valuations are not much correlated with the late stage public stage valuations, but the trickle downs, because at the end everybody, all the VCs or Ps see their exit in the form of M&As or on the IPOs, majority in the form of IPOs. So there, what happens is, that is where public markets typically, valuations of private markets have a lag to that of a public market. There's always a correlation, but with some bit of a lag. So if that overvalues, and then overvaluations can be easily felt here, and if that meltdown happens there, then the valuation stretches or the devaluations can be seen in the private markets.
So quickly, from the way I look at it, I don't think you will see the euphoria that you saw in the last 2 years going to come back anytime soon, right? Having said that, VCs are also, investors generally look for growth in startups. So you also don't want to be in a situation where you have a company that's profitable but not growing, right? No investor would like to touch companies like that. So at the end of the day, there's a certain amount of growth that is kind of required from a market, capture and so on and so forth. But I expect sometime very soon, maybe sometime next year, like I said, there is a lot of dry capital there. That will be put to use. But it nowhere means that you will see the amount of valuations, capital being raised, or the kind of funding that you will see that you saw in the last 2 years.
So if you look at, world at a large, there is an economic stress, there is geopolitical stress, some of the geographies are not growing. India is the only country, which is slightly performing better. I'll not say it's insulated, but it's performing better in terms of consumption as well as spending, right? And all those companies which you referred for listed space have certainly gone through operational efficiency. And the beauty about stock market is that if you're showing the performance, there is a reward. And the reason being these companies are getting appreciated because they have started showing improvement and they're also looking to be profitable. When it comes to our space, I think a lot of money is already looking to get invested. As far as recovery is concerned, like as I said earlier, the early stage investment never looked bad in India. In fact, investments are happening either in public domain or private domain. But overall, to me, it looks like we have got onto path of the recovery. Now, it's a question mark, as rightly told by Renjit, whether we will see that kind of euphoria what we had. I don't know, but certainly it will be much better compared to rest of the world.
Thanks, Anil. I think, it's hard to predict, right, Manu? I think recent numbers, September, October look decent. I think Renjit was making the point, 2021, 2022 were anomaly years. I don't think we should compare it with them. I think one other comment I would make personally is, I think we need to stop celebrating valuation raises and markups so much, right? I mean, when this whole tagging of a unicorn happened 10 years back, there were only 30 unicorns. Today there are 1,000. I think we need to stop celebrating valuation and start focusing more on, sustainable, lasting, profitable companies. I think that's where companies are pivoting to now for good reason. So that's probably a good story anyway from all of this.
So with that, we come to an end of this conversation. Thank you. Great conversation.